Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 56 of Real Talk. Well, usually the summer is a time for slower transactional volume. We are in the midst of a pickup. I don't know if it's coincidental or if there's something changing in the market, but it is definitely nice to be busy again, working across all asset classes. We've got a large hotel deal in Orange County, a distressed office deal in downtown LA. We just closed a large industrial deal, a 9-figure one. Several multifamily deals have come online with some new LOIs and PSAs, development deals, construction deals. So things are certainly picking up. We'll see if it takes us through the end of the year. This week, we have Jay Parsons from Madera Residential. Jay is a real estate economist. He came onto the show to talk about what's really happening in the multifamily industry, whether rental rates are staying high or whether they're coming down, where we are in development, geographical trends, sunbelt versus coastal markets. It's an interesting conversation to get the nuts and bolts from Jay Parsons, who is one of the leading economists in the multifamily industry. I hope you enjoy my conversation with Jay Parsons.
Welcome to another edition of Real Talk. I'm here with Jay Parsons, Head of Investment Strategy and Research at Madera Residential. Jay, how you doing today?
I'm doing great. Thanks for having me.
So where do I find you today?
I'm in the Dallas, Texas area.
That's great. Well, Dallas, it's funny. I was talking to my son last night. We were watching it was a hockey game. Yeah. Even though we're not big hockey fans, Dallas Stars were playing Edmonton. I said, wow, if you think about it, Dallas with the Texas Rangers won the World Series. They're about to go to the NBA finals. They may go to the Stanley Cup finals. It's like the epicenter of the sports universe in Dallas. Now you just need the Cowboys to make it to a Super Bowl.
Yeah. The Cowboys are still kind of punching bag, but it's been good other than that. Like, I'm not really a hockey fan, but it's hard not to get sucked into it when they're playing like this.
Yeah, and you got the Mavericks. So
the Mavericks are great. Yeah.
Well, I didn't have you on to talk about Dallas sports, but I could do that very easily.
Oh, that's too bad.
So Jay, why don't you talk a little bit about Madera Residential and what you do for them? I know we met before we at a YPO conference a few months ago in San Antonio, talking about the multifamily industry, and so with that landscape, I really wanted you to come onto the show and talk to my audience about Madera, about what you do. So take it away.
Well, sure. And thanks again for having me. And it's good to see you again. So my background is in rental housing economics and research. I've been doing that for 15 plus years. And then earlier this year, joined Madera Residential to head up investment strategy and research. And Madera is a Texas-based owner and operator of apartments, about 11,000 units today, a little more than that. And it's big plans to keep growing. And so I got to know the partners a little bit, and they had just a commonality of values, both around people values, but also investment strategies and values. They want to grow across the sunbelt and do some different things around all the asset classes and multifamily. And that's what kind of drew me in. So we can get more into that if you'd like, but that's the high level story.
No, absolutely. I know research is part of, your profession, and it's in your title, and it's what you've done for many years. And so what are you seeing out there? I mean, there's interest rates haven't come down yet. There's talk when you peel through the Fed notes about one of the reasons why they haven't reduced rates is because the price of housing and specifically the rental market and the cost to rent. Yet so many of my clients that are on the sponsor side who have apartments in the sunbelt, Texas, Phoenix, Vegas, Atlanta, Florida, etc., they're all saying the opposite, that rents have either flatlined or are coming down. So what does your research show?
Yeah. So it's interesting because just to give you a quick little history here, our last big inflation period in the 1970s, home prices were still part of the consumer price index. They're a big part of inflation. And so the government economists back then got together in the early 80s. They said, hey, we got to change this up. It's too much volatility. And, the CPI is obviously not just how we look at inflation, but it's also used for, things like Social Security benefits. So having some stability was really important. And so they came up with a new concept to measure housing costs, and it took out home prices and mortgage rates and everything else that we typically associate with, basically monthly costs for homeowners. When homeowners represents 2/3 of all American households, or almost 2/3, and they came up with this concept of owner's equivalent rent and rent of primary residence. And so the punchline is that it's really about a third of the consumer price index in the U.S. is measured by primarily a survey of renters asking about their renting costs. And on top of that, there's some various lags that are built in. And I won't bore everybody with the details here, but a lot of this, when you hear about what sponsors say and what you see in headlines, it's a different metric of what they're measuring versus what the Fed's looking at from the Bureau of Labor Statistics. And so in our industry, we talk about this, they're looking at the headline rent, the asking rent. This is what a new renter pays coming in the front door. And right now, you're right. Really all across the country, with the exception of the Midwest and some of the Northeast, we're seeing asking rents that are flat or negative. And a lot of that's because of supply coming to the market. And we can talk more about that later if you'd like. There's more supply than demand. It's great demand, even more supply. That's putting downward pressure on rents. But what the Bureau of Labor Statistics is looking at is trying to measure all rents that everyone's paying, regardless of when that rent was signed. And so, for example, this survey is done every 6 months of the same renters. And so if you were surveyed today and your rent changed tomorrow, you're not gonna that change isn't reflected for another 6+ months in the consumer price index. And so in the thought process, hey, your rent doesn't change every day, so we shouldn't be checking it every day. It's the same price you have for about a year or so. And so that's what we call it, the in-place rent roll. They call it the contract rent. But it's one of many lags that's built in. And that's the reason there's this disconnect today between what's really happening on the ground, which is that rents are falling or flat, versus what's being reflected in the consumer price index, which again is quite lagged.
Yeah. And so when you do your research, I mean, what are your conclusions about I guess where we're headed from a rental standpoint or rental rate standpoint, and maybe if you want to touch upon the supply that certain markets are seeing, especially in the sunbelt.
Sure. Well, sticking on the rate topic for a minute, the way that there's multiple flavors of rent, and for those who aren't in this industry every day, it seems like, hey, the rent is the rent. It's one number, right? No, there's like 12 different flavors of rent, different versions of rent. And so what's happening is that the asking rent, that again, the one you see in the headlines or for the news, whatnot, this is the leading indicator. And so if I'm a prospective resident and I'm looking at a particular property and you tell me it's $1,500, you can't then go to an existing resident and say, hey, we're going to renew your lease for $1,600, because they're going to see that rent advertised on the website or on the, a sign or something. Craigslist, Facebook Marketplace, wherever it is, like that, those numbers are more transparent than ever. And so it's very difficult to push rents above that asking rent. And for the last couple of years, there's been a big gap in kind of what existing renters are paying versus these new renters, because the new lease rents had gone up so much. There's a big gap we call loss to lease, and that's been a race. So basically, as these leases are being renewed, they're already closer to market, and that limits how much these rents can be increased even on renewal. And so my point in that is sharing that I think that we're going to continue to see. It's not that the CPI's version of rent is going to go negative, but it's going to continue to be trending. It's going to continue to be cooling, moderating growth. And on the kind of the headline rent side, I think we're going to continue to see flat rents and slightly to moderate negative rents in some markets through this year, and I think it'll be next year when we start to see some moderate rent growth return again. On the supply point, we're at 40-year highs in apartment supply right now. We saw peak deliveries come. We saw a lot of apartment starts back when debt was cheap and rents were skyrocketing. And the one I always tell people is like, hey, even if you're a consumer, if there's any positive side to rental inflation for a consumer, it's that it spurs a lot more supply. It's not an immediate fix, but after a couple of years and those starts turn into completions, you see the benefit of it. That's what's happening right now. And so these completions are going to peak this year and kind of spill into the first half of next year. And then by end of 25 and in 26, there'll be, relatively fewer completions. And so, within the industry right now, there's a big focus on, kind of survive till 25, or it'll fix in 26, or it's heaven in 2027. I mean, all these different kind of expressions out there. But the point being is forecasting is inexact science, but we know supply is the easiest variable to forecast. It just starts to push forward, and that's going to be it's the biggest headwind right now for rents, and it'll quickly over the next call it 12 to 18 months gradually turn into a more of a tailwind for apartment operators.
Yeah, I want to get more into supply in a minute, but just going back to rent, isn't the actual net effective rent really the most important figure, because landlords are providing maybe a month or two of free rent, throwing in a toaster, whatever it is, what it is these days, from utilities to gift cards, and so how is all of that factored into the net effective rent? And does the Fed or the Bureau of Labor Statistics, are they looking at that net effective rent, or they're just looking at the face amount and they just sort of ignore of what goodies a tenant got when they were signing a new lease?
Yeah, that's a great question. And the way that the survey is worded, it doesn't really specify that quite enough. So what it asks is, hey, what are you paying for your rent? And then separately talks about utilities. And so if you're getting a concession, does the renter, are they including that or are they not? And if it was a 1 month free, are they amortizing that throughout the lease, which is what an economist would really want to do? And I'm guessing probably not. And then you mentioned like the non-rent concessions, things like gift cards. It used to be like 10 years ago, it was the free flat screen TVs. And I think those are kind of going away. I mentioned like the toasters, that was probably from a little further ago than that. But those type of things are not, to your point, not be able to captured by, the Bureau of Labor Statistics either. And so, that's one of many reasons why it's an imperfect survey.
Yeah. All right. So when we talk about supply, I'm here in Los Angeles. We have a national practice where we transact throughout the country. Coming out of COVID, if a client of mine was trying to buy an apartment building in Southern California, they'd have absolutely almost no chance to little chance of getting the institutional world interested. They all wanted to be in the sunbelt. Fast forward a couple of years, now we're seeing a reverse trend that our clients are moving away from the sunbelt and going back to the coastal markets because of the oversupply. And here I'm sitting in LA, and the number one issue that our local government is trying to combat is housing costs, homelessness, things of that nature that I don't think you guys are facing in the Sun Belt. So are you experiencing and seeing this transition or migration of capital back to the coastal markets and away from the Sun Belt?
Yeah, that's a good question. I think it's a hot topic. And I guess first and foremost is there's just not enough capital flow right now to, I think, draw any firm conclusions. But I can tell you,
fair enough on that. Yeah,
I think there's a couple things that are happening. I think, the Sun Belt's not going to go away. Investors follow demand. But I think what we're going to see is in this last cycle, there was so much kind of, I would call, relatively new capital chasing heavy value add strategies in less desirable submarkets. So give me an example. It's like, I'm here in Dallas, and you would see these, syndication groups that were just wanting to be somewhere in the Dallas MSA. and they're buying, Class C and, the least quality submarkets of Dallas, and then trying to do a heavy value add program. And, I think that the initial inflation period made some investors look really good, but ultimately, depending on the timing, is that stuff's very, very tricky for a lot of reasons. On the flip side, so I think you're going to see diminished appetite for those type of deals, and that's going to maybe look like there's less capital coming in the Sunbelt. But I'll tell you, talking to a lot of different groups, like there's still a lot of interest in these markets. But I think it's going to, especially right now, it's going to be newer vintage, higher quality, better locations in the Sunbelt. Now you look at the coastal markets, I think there's also a little bit of a change where, you look at, this last, the COVID period has really, I think, reclassified some certain cities. So you mentioned, I'll give you an example, like Los Angeles, like Southern California is still certainly in favor among a lot of investors. But you look at like the city of LA, you have some investors now redlining altogether because they don't trust the city council. I mean, you probably know about this, but there was a city council meeting, maybe it was a county commission, anyway, city or county, where one of the elected officials gave a speech saying, hey, evictions are a public service that we provide to landlords. Why are we doing this? And not really understanding, like, okay, there's a lot of reasons evictions can occur, and this went on for quite a bit. And and then if you, of course, you have the mansion tax issues, you have a lot of other issues where, there's a question of, hey, like, if you're an investor, do you want to be where you're not wanted and where you're going to have a really hard time? Or do you want to be like benefit from the broader dynamics of that region and maybe be in a different city within that region? And I again, too early to say conclusively, but I think you're going to see some migration of capital kind of from kind of core city locations into some of these more kind of perceived to be business friendly suburban. Suburban's almost a bad word because these are, like, some of these cases, very big cities themselves. But picking markets where they perceive to be a more friendly operating environment, if that makes sense.
Yeah, absolutely. I mean, look, the city of LA has been redlined for a couple of years because of the mansion tax, regulatory policies, things of that nature. Obviously, California is a big place, 35 million people. Yeah. You would, if you were following the news or believing the news, you would have thought that the entire state of California moved to Texas, and therefore Texas is now like 60 million people.
It's the funny thing is some Texans think that too, and obviously it's not exactly true. So
yeah, there were plenty of funny videos coming out of COVID of Dallas families inviting or coming over to the houses of newly transplanted Californians, and Californians saying, "What? Who? These people are coming over to say hi. What are you doing? What do you want from me? We're just trying to be neighborly. That's what we do here in Texas."
That's great.
Yeah.
Well, and by the way, I'll give you another example. I just recently, the census put out some data, just kind of to your point, maybe think about this, data on population movements. And one of the fastest growing cities in the U.S. over the last 3 years was in California. And I'm probably going to mispronounce it because I'm not from the area, but it was Lathrop or Lathrop in the Stockton area, but it was basically an hour commute from the Bay Area. And I'm going to butcher this quote, but there was an article in the San Francisco Chronicle, I believe it was, about, hey, like, what's going on in this one little suburb of Stockton? And they were growing like, something like 35% of the last 3 years. And they quoted the city manager, and they're saying, hey, well, you know what? Like, our whole business model is we don't put up roadblocks to development. Like, we want to grow. We want to be business friendly. And hey, what do you know? Even in California, it works. And so, to your point, you can't paint with a broad brush.
Yeah, I mean, look, the weather out here, although it's cloudy today, that's why people want to be here, and then the jobs and the economy, and for the cities that are business minded, and there are cities that are business minded in California, they're capturing the investment dollars. So whether LA County is, I think, 10 to 12 million people, the city of LA is only 4 million. So the surrounding cities, whether it's the South Bay, like El Segundo, Manhattan Beach, or if you go out a little further west from, Calabasas to Oxnard, et cetera, you're still within the general MSA of LA, but you're in smaller cities that are more business friendly. Let's turn the conversation over to Madera. And so for my audience that may not know Madera, what are you guys focusing on these days?
Yeah, so historically, Madera, as I mentioned, 11,000 plus units all in Texas and all in the major markets, DFW, Houston, Austin, San Antonio, and mostly DFW and Houston. And so, they've been very successful going from, everything from new development to, Class A plus towers all the way to, kind of Class C workforce housing. And so the next step has been kind of a couple of things. And what I'm really excited about in my role is, number one is we want to move into new markets. And we're going to, start in markets that are pretty similar to Texas. And we're still working this strategy and the process of, kind of working through this. But looking at other major sunbelt markets where that same model can work. And we have maybe development partners or relationships with brokers and lenders in certain markets that make sense. And then secondarily, something I'm particularly excited about as well is a big focus on attainable housing. And, attainable is one of these kind of vague terms, but it's not fully defined. But this is really the middle income housing. People call it workforce or attainable. And we're seeing, and personally, I believe we're going to see more and more of this. I think we're at the beginning of seeing more and more elected policymakers kind of making a pointed effort toward boosting the supply of middle income housing. And so in Texas, we have what's called the PFC program, Florida passed a program called Live Local. And basically, they're all different, but in Texas, for instance, it's a property tax abatement in exchange for keeping a certain percentage of your rents at certain thresholds of area median income that are, let's say 80%. And so, the reason this is so great is that, it's kind of part of the whole missing middle concept that we hear about right now across America, where like the low income housing tax credit program is primarily the lowest income housing. And if you just take rough numbers, national 60% of area median income would be like $35,000, $40,000 incomes. Now you look at Class A new construction, that's typically 110,000 and up household incomes. That could be two roommates, two 28-year-old guys making $60,000 each. And so that's a whole missing group in the middle of that where they don't qualify to live in new construction. Now there's still, older properties they could live in, of course, but that's typically a diminishing stock of supply where you're losing units to either obsolescence or to value add upgrades. And so there is a real shortage, kind of a chronic shortage of this middle income housing. And so we're really big on this, whether it's naturally occurring attainable or, purpose, kind of subsidized attainable housing through these tax abatement programs. Again, I think, and we're not the only ones to be saying this. This is I think a growing area of focus across from both the policy side as well as the industry side right now. I think it's a kind of a round peg, round hole type issue, but something I think again we're kind of in the early innings on, and I'm excited to be part of that from Madera's side.
Yeah, no, absolutely. I've got several clients that are playing in that space. Obviously they also play in the affordable, they play in the market rate and this missing middle. With respect to new construction though, it seems so challenging to get capital for construction, right? Yep. Most of my clients who are trying to obtain capital or my clients who provide capital will say, you can buy below replacement cost. Yep. Fairly new vintage buildings these days. So why would I put my money into a new construction project? How do you combat that sentiment?
Well, they're right. I mean, it's not, typically it is cheaper to buy than build. Now, number one, that's not going to last forever, obviously.
Right.
But number two is you've got to find ways to reduce your costs. And so, the one way to do that is, I always look at my heels. Like I have this debate sometimes with like the affordable housing advocates who a lot of things we agree on, but some things I'm like, guys, like they want everybody to build, these market rate developers to build affordable housing. And you have to explain to them, okay, well, listen, land isn't cheaper because you want to build affordable or attainable. Yep. Construction labor, the workers aren't going to discount their labor rate because you want to build attainable or affordable. The materials, a lot of the fees are still the same as well. And so you just because let's say you lower your ceilings by a foot and you put in, cheaper countertops and those kind of things and flooring, like you're not going to make the property dramatically cheaper. You're not going to lower your costs either. And so to solve this both from an affordability side, but also from an investor standpoint, making these deals pencil out to be attractive, you've got to lower the cost. And so again, like in Texas, there's this program again called PFC, where it's a property tax abatement. And in a place like Texas, we don't have an income tax, and so our property taxes are higher, and so property taxes are the highest expense, the operating expense that a property has. And so if you can reduce or push that tax off for a period of time, all of a sudden these deals could pencil out. And so that's where I think we're seeing a higher percentage of these deals that actually get built, are part of structures like this, where there's some type of subsidy or abatement that allows it to pencil.
Yeah, or even debt that has more favorable terms because of the affordableness or workforce housing. Additional leverage, maybe some help on the rate, and that's where, in fact, some of my clients where we've done deals on existing market rate, let's say Class C product, maybe B minus, sold to buyers who were going to convert it to affordable, and they were able to pay more for that product because the debt was so much more attractive to them as an affordable deal. So
that's a really good point. Yeah.
What are some of the markets, if you're able to share, that Madera is thinking about going into?
Well, as one of our partners, Charlie Young, he likes to say that it's easier to tell you what markets he does not want to invest in right now, and that's somewhat tongue in cheek. But no, I think the markets that again, I would just tell you more from a personal standpoint, I think are very attractive, and ones that I'm certainly favorable to would be markets that today are perceived as higher supply, and have also had, I think, higher share of deals been syndicators who are less likely to be, left standing over a longer term. And so I don't think we're going to see. I want to be careful. I don't want to say we're seeing like drastic discounting, but I think you're going to see some value over the relatively short term for investing in markets that are currently perceived to be oversupplied, and so but still have very high demand. You look at places that have a lot of population growth, a lot of demand. So particularly markets like the Carolinas, Charlotte, and Raleigh, and even some of the smaller ones. Nashville obviously is one, as well as places like Orlando, Tampa. Still a bit less favorable in Atlanta from that region. So those are some examples. I think the Southeast is probably more than likely where we'd look at first, although again, subject to change.
Yeah, and I guess I want to leave you, and thank you for your time, by the way. And in our remaining couple minutes here, want to discuss. You talked about the potential for seeing some better deals down the road. It's been about 2 years of a dislocated market, right? Since middle 22, now entering the summer of 24. Folks, I would say 18 months ago, 12 months ago, would have predicted that there would be significant sales, distressed sales, note sales in the multifamily world. We have not really seen it in scale like what we saw coming out of the GFC. I mean, what is your prediction over the next second half of 24 going into 25 in terms of the cap rates and are we going to see this higher volume of distressed transactions in the multifamily space? We're seeing it in office, but specifically to multifamily, we're really not.
Yeah, that's a great point. And, I think part of that is, the headwinds in multifamily are perceived to be short-term related to supply versus office. There's a big cloud of uncertainty. I'll tell you, about a year ago, I asked a poll question on social media, and it was, obviously not scientific, but got, thousands of people respond to it and said, hey, is there going to be more distress, non-office distress? They take office out, like more actual physical distress or investors chasing distress? And it was like 3/4 of the respondents said it'll be people chasing distress over actual distress. And I think that's still true. And I think there are a couple of reasons for that. Number one is I think people don't talk about this enough, but lenders, especially the big lenders, they learned some lessons coming out of the great financial crisis. And one of those is that when you start foreclosing on properties, taking keys back, it affects not just that one relationship and that sponsor. It affects your entire portfolio, because all of a sudden values start coming down fast, and you're having this whole mark to market thing and all this other stuff, and it creates a lot of problems. And so I think there's much more, and to the credit of even people like to knock on the regulators, but even the FDIC and others have written guidance saying, hey, work with your borrowers who can work with you. And so we're seeing a lot more patience among lenders of all types who can be flexible, where they're being flexible, and I think that's going to continue to play out. We're going to see a lot of, I think, deals kind of quietly resolve behind the scenes. So I do think we're going to see more stuff hit the market this year and in next year. But I think it's going to be, more kind of lowercase d distress as opposed to major distress. Like a seller has to get out of it, but they're not going to be, I don't think you're just going to see a lot of deals that are selling for the value of the note. I think those deals are pretty much the exception to the rule.
Yeah, I mean, it feels like from a capital markets perspective, there isn't a liquidity crunch from the capital. Maybe from the borrower and operator and sponsor, there's a liquidity crunch, but these banks are not fire selling their loans or agreeing to short sales just to get capital back in droves. We're seeing it in office. We're seeing it, one off here and there in multi. I think people were expecting that by this time, summer of 24, especially regional banks and some of the debt funds would be in such dire straits that they would have to offload product in order to raise some capital. And we just haven't seen it.
Yeah, no, you're right. And I think part of it is another part of that too is with these debt funds, like there's not really there's no upside to taking over these properties either. And so they're and a lot of them, and the other thing I'd point out too is a lot of these debt funds too have equity backgrounds, and so they're potentially even able to take over the property if they have to, and not have to sell it at a distressed price. And that's more, again, not super common, but still we've seen a couple of cases where that's happened. And the other thing I'd point out too is there's entire funds being raised out there to buy debt. And it's not just buy the property, buy the debt, and then maybe even hope that they can eventually take over the property. So to your point, it's not a liquidity crisis. There's a lot of capital that likes the long-term story around multifamily right now. But I think there's still there's still a little bit of a mismatch between buyer and seller expectations. And I think that's the big reason why there's still not a lot of volume quite yet. Yeah.
And, the preferred equity market that's out there, I mean, we're doing quite a lot of preferred equity deals where, a sponsor borrower needs to refinance their agency debt and their proceeds aren't quite there. So they're getting preferred equity to bridge the gap. And, it's still expensive money, 15, 16%, maybe a little lower depending on the type of product and location. But borrowers are choosing to go that route than selling and taking a loss or trying to just get, back to even. Instead, they're taking on this higher octane preferred equity capital that's available to them, trying to survive to 25 or beyond. Hope interest rates come down in the next 2 to 3 years. Maybe rents will stabilize, continue to go up if the supply market, reverses itself in a couple of years, and then take that asset to market and sell it in 27, 28. That's been the business model that we're seeing as opposed to fire selling their assets.
Yeah, and you're 100% right. I mean, you think about it for anybody who's watching this, you just think about this from the perspective of the borrower.
Jay, I hope there's someone watching this.
Well, no, I mean, for everybody watching this, sorry, bad phrasing. Who maybe not understanding what you're referring to here, Andrew, is like if you just put yourselves in that person in the sponsor's seat, if they sell at a fire sale loss, not only are they taking a loss, but they probably can never go back to their investors again in a future cycle and try to raise capital. And so for some of them who are in a tight spot, the best thing they can do is hold on as long as they can, try to at least get their investors' money back or get them a little something back, even if they're not making what they hoped for themselves. And so there's really, there's very little incentive or reason to kind of throw up the white flag right now, especially if there's preferred equity available.
Yeah, well, that's definitely the long-term approach, and wanting to preserve capital of their investors, even if they're not in the money and they're not going to get a sizable promote or any promote. They're seeing the long term. Well, Jay, I really appreciate you coming on. I know you were such a wealth of knowledge in coming to our YPO conference a few months ago in San Antonio. So thanks for being a fan of the show, for coming on to the show, and giving your words of wisdom to hopefully my one or two listeners and viewers.
Well, no, I thanks for having me, and I appreciate it. Hopefully all your tens of thousands of viewers enjoyed this. So
yeah,
thanks again, Andrew.
Absolutely. And good luck to the Dallas sports teams rest of the way. All right. Take care.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scholarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.